Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Indirect Cost Reminders and Strategies for Tribes. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to introduce today's presenters from Moss Adams, Anita Shah, Partner in Tribal Services, and Tasha Repp, Partner and Tribal and Gaming National Practice Leader. Their bios and contact information are located in your webcast console if you would like more information. And now I'd like to turn the floor over to Anita to get the presentation started.
Thanks, Amy. Hello, everyone. When we were trying to figure out what people would want to hear on this indirect cost webcast, we figured indirect costs can get complicated pretty quickly, so we decided to start with the basics. We'll start with the definitions on the terminology that's typically used in an indirect cost process. Then we'll go through the indirect cost calculations and the annual cycle of indirect costs. And then we'll talk about strategies when it comes to choosing a direct cost base and the differences between the non-638 funding and 638 funding. And with that, Tasha will get started with the presentation.
Thanks, Anita. Welcome, everybody. As Anita indicated, I am going to do a run-through first just of the basics and terminology as a level set to make sure we're all operating from the same playbook. But before we get started, we want to understand a little bit about everybody that's participating and kind of what kinds of rates you might have established. So we've got polling questions throughout, and we're going to start off with our first polling question. So Amy.
All right, thank you. The first polling question, does your tribe have a negotiated indirect cost rate? A, yes, B, no, or C, use the 10% de minimis rate allowed by uniform guidance. And we will give you a few moments to respond. To respond, please click the button next to the answer you choose and hit Submit. And if you cannot see the Submit button, you will need to enlarge the slide area. And I do see some responses coming in through the Q&A. If you want to receive the CPE credit, you will need to respond on the slide.
And while we're waiting for those responses to come in, we're hopeful that a lot of you on this are this presentation is really focused on tribes and related entities that submit negotiated indirect cost rates through the Department of Interior to their Interior Business Center. There'll be a few of these strategies that apply regardless of who you submit your rate to or whether you use the de minimis rate or not, but the primary focus is on those that are working through and have established rates. And that's great, because that looks like that's the majority of everybody participating today. So with that, we can go ahead and move forward. So we're going to start with just thinking about how do you accumulate costs that get charged to your federal awards. And there's really, two buckets. First, you have direct costs and indirect costs. So let me talk about direct costs a little bit here. Direct costs can be identifiable, so it's one specific invoice that was initiated and charged directly to a program or a grant, so that's a specifically identifiable cost. But you can also have allocated direct costs that you charge directly to a program. So an example of that might be utilities for a particular building that's getting allocated to program costs, or sometimes we see phone costs where you're taking that phone bill and allocating out cost to each grant or program. And then the indirect costs are really meant to be those that aren't separately identifiable as, directly to the program or the objectives around a federal award. And we're going to talk a lot more in detail on how to focus on the different types of indirect costs that you might be able to claim, and again, kind of looking forward to strategy on maybe how to maximize ensuring that those indirect costs get paid through the federal award. So when we look at the definition of indirect costs, we look to the uniform guidance, right? That's where it all comes from. So we're starting with that 2 CFR 200 reference. In the uniform guidance, they sometimes also refer to this as facilities and administrative costs. For those of you with self-governance or Indian Self-Determination Act funding from the BIA or IHS, sometimes you might get heard of this as contract support costs or CSC costs. But that's all really trying to describe that administrative indirect overhead costs. And really it just boils down to costs that are incurred for a common or joint purpose that benefit more than one cost objective. And a cost objective could be multiple grants, it could be multiple departments, cost objectives can be pretty broadly defined. And then this is the caveat that I think is important to keep in mind when we're thinking about what's indirect, is that because they're not readily assignable to a cost objective where you can kind of see that benefit that entity receives, you only have to do those types of allocations if the effort to kind of do that allocation is not hard, right? So it says if the process to go through a more detailed allocation is difficult or disproportionate to the results achieved, that's an opportunity to say something's indirect. If it's really hard to figure out to come up with an allocation methodology where you might be able to allocate it directly, those are really the areas that it's key to focus in on assigning it as an indirect cost. So when we think about the types of costs that get included in a typical indirect cost pool for an Indian tribal government, clearly we're seeing a lot of, again, these types of costs that are broadly helping multiple programs, multiple cost objectives per that definition, and aren't easily allocable or assignable, and so they get included in that indirect cost pool. And so you'll see things here like property, insurance, utilities, a lot of your key support staff throughout the government, so whether that's accounting, human resources, maintenance, IT, audit costs are of course allowed to be included in that allocation. Tribal council costs can be allowed up to 50%. So again, this got codified quite a while ago that if you want to charge 50% of your tribal council costs to your indirect cost pool, you can, without making your tribal council members keep a timesheet to substantiate that that's where they spend 50% of their time. There's an allowed presumption that up to 50% of tribal council costs can be included without that additional substantiation. Now, that doesn't mean that you couldn't try to have more than 50%, but if you want to charge more than 50% of your tribal council costs, you would have to have that timesheet or that other substantiation that shows that they're really spending effort more than 50% of the time on really these broad kind of administrative things that aren't considered economic development or other areas that we know tribal council spends their time on. We also get a lot of questions on attorney costs, and certain attorney costs can be included. You can try to negotiate with the Interior Business Center on that, but again, it's really wanting that detail on how much time and effort your attorneys are really spending on things like negotiating grant agreements and reviewing contracts and things that benefit all programs, not on specific claims, again, or economic development or other areas that likely wouldn't meet the definition of indirect. And so those are a lot of the areas. There's plenty of others that come up, but those are the common ones. And again, the focus is on costs that benefit multiple programs. And so that's what gets included in your indirect cost pool. So in relation to the indirect cost pool, one of the other areas, other than kind of like what types of costs are in there, is how do you account for them in your accounting system? Where do they fall in the accounting system? And the uniform guidance doesn't really prescribe how you do the accounting for them, and there's a couple of different options that we'll talk through here. First and foremost, though, is that the Department of Interior has requested that your indirect cost pool expenses do get shown separately somewhere in your annual audit. So some tribes have that as a supplementary schedule to their financial statements. For some tribes, it's its own fund in the financial statements that lends itself to that. I know a few tribes that have that information in a footnote to the financial statements, but that really does help the negotiation process when the Interior Business Center has that information in the audit that they can tie back to. As far as kind of where it gets accounted in your accounting system, you know, the two most common that we see are it's reported as an internal service fund, and there's some advantages to that. That makes it kind of easy to monitor as a standalone fund, or from a budgeting perspective to kind of monitor your shortfalls, like how much are all of the federal agencies paying for your actual costs that you're incurring. But, you know, it's not the only way to do it. We've also got a lot of our tribal clients that keep those costs in the general fund. When you think about some of the activities that are in there, like tribal council, like accounting and HR and maintenance, a lot of tribes have those as a separate department in the general fund, and they can continue to kind of track and monitor it that way. It does maybe create a little more work to make sure that you're only including allowable costs when you're using the broad kind of departments or general fund. But as long as you've got a process that you can reconcile back to, that should be sufficient. And again, there's no prescribed requirement on how you do that. So the other half of the equation when thinking about how you put together an indirect cost rate and that process is what the direct cost base is. And the direct cost base is really just all of the programs and functions that these overhead and administrative costs are going to get allocated to. And there are multiple ways to do that allocation. So the three methodologies that are allowed by the Department of Interior are something that's called total direct costs minus any capital expenditures and pass-through funds. A lot of people still use that, although the next two options might be a little bit more administratively feasible to manage. So they also allow for total direct costs and wages, or total direct salaries, wages, and fringe benefits. There are pluses and minuses to both. What I would say is just make sure that periodically you evaluate, does the base that you're using continue to make sense? For that total direct cost minus exclusions, there can be a little more work to make sure you're getting that calculation correct, that you've got the right exclusions that you're using, and that salaries and wages piece makes that calculation sometimes a little bit simpler. But you'd want to look at, the benefits of how does that impact the overall allocation and how does that impact the overall amounts that Anita will talk through here in a bit when we talk about strategy. And with that, Amy, I think we've got our next polling question.
All right, thank you. Our second polling question: which of the following are an allowable direct cost base type? A, total direct costs less capital expenditures and pass-through funds. B, total direct salaries and wages excluding fringe. C, total direct salaries and wages including fringe. D, A and B, or E, all of the above. And also just a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions.
Yeah, and again, this can change over time. So I've got plenty of clients who started with one base and then kind of moved to something else later on. They do ask that you don't kind of change it year over year, that there's a couple of years that you stick with a similar methodology, but I think it's good to reevaluate. The other thing that I was just thinking of is that clarification on that total direct cost less exclusions. Just to frame this up, because we did have a few people in the previous polling question that indicated they're using the de minimis rate. The definition that the Interior Business Center uses for total direct costs less exclusions comes from Appendix 7 of the Uniform Guidance. The total direct costs less exclusions for the de minimis rate actually comes from a different section of the Uniform Guidance, and although they are very, very similar, there are a couple of slight differences there. So it might be good to refresh if you're using that de minimis rate to make sure that you're really understanding what those differences are. All right, and we've got, wow, a lot of people using all of the above, a mix of A and B, and a smattering of everything else. So our strategies, I think, that we'll talk about and kind of concepts that we'll talk about should hit on benefits no matter which base you're following, and we'll keep that in mind as we go forward. So then at the end of the day, right, we've got these indirect cost pool, these pooled overhead costs that we're wanting to allocate to the rest of the tribe's programs. And we've got the base of programs that's receiving the benefit of these administrative and overhead services. And so you end up with an indirect cost rate, which is really just, a ratio expressed as a percentage of, the indirect costs divided by that direct cost base equals some percentage, which is the proportion of indirect costs that each program should bear. And we'll talk a little bit about that too, because as I'm sure most of you are aware, when you're negotiating indirect cost rates and thinking about that indirect cost, that direct cost base includes not just your federal programs, but it can include state programs, it can include programs funded by the tribal government through the general fund. And the presumption is that because those indirect costs are broadly allocable to all programs, that every program is sharing in the cost of basically operating those administrative functions, and then, there's a presumption that all of those programs are bearing their fair share. Now, we'll talk a little bit about how to strategize around that, because clearly we know that not all programs pay their fair share, and so that'll be part of what we talk about here in a moment. And with that, I'm going to turn it over to Anita to talk about more of the mechanics behind the rate structure.
Thank you, Tasha. So yeah, I'll start out with the calculations and then talk about the cycle. So Tasha just mentioned this, but here's the visual of the indirect cost calculation. Your numerator of the equation is your pool's indirect cost, all of the costs in your indirect cost pool. Divide that by your direct cost base, whichever direct cost base you use. Tasha went over all three of them earlier, to get to your indirect cost rate. So pool divided by base, you get to your rate. So how that works for a federal program is you're going to, once you have your negotiated rate, you multiply that rate by your direct cost base to calculate your indirect cost recovery. Your indirect cost recovery is the maximum amount of indirect costs you can charge to that federal program based on the rates and the base of that program. So indirect costs are not reimbursed based on any specific activity. They're based on your total direct cost base. So this calculation, keep this visual in mind because we'll be talking about more indirect costs in our examples here in a little bit. So at the beginning of the year of an indirect cost cycle, you establish a rate for the coming year using your budgeted costs. So your budgeted indirect cost pool divided by your budgeted direct cost base will give you the rate that you would use for the following year. And so, for example, if you have $100,000 in an indirect cost pool, you divide that by your direct cost base. In this example, it's $500,000 to get to your indirect cost rate of 20%. And to put together this rate, you have examples on the Interior Business Center, which is the agency that you negotiate your rate with. It's a Department of Interior agency. They have examples, templates for the indirect cost proposal on this website that's listed here. They also have a sample proposal, so you have something to base that off of if you're starting out, if you've never done an indirect cost proposal before. So once you establish your rate, during the year, as you're incurring your expenses in your pool, so Tasha mentioned some examples of your indirect cost pool expenses. So for example, salaries and fringe of your accounting staff or your IT or HR folks, insurance, repairs. So here's an example of, or a journal entry example. As you're incurring those costs, you would, in your indirect cost pool fund, you would debit those expenses and you would credit cash. I did not include the AP entries that normally go with this, but you have a general idea what the entry normally would look like for an indirect cost pool, for your indirect cost pool fund as expenses are incurred. And then on the flip side, as you're incurring these expenses in your indirect cost pool, now you're going to charge your programs for your indirect cost expenses. So you're charging them based on the rate that you negotiated. And that calculation, the charge that you make to your program can be done on a monthly basis or a quarterly basis. Monthly basis will give you a more timely, will give you and program directors and council a timely information about your P&L. So in this example, let's say the IHS program spends $25,345 on direct costs in the month of January. And they have indirect cost rates of 20%. So when I multiply that direct cost with that indirect cost rate, we get the actual indirect cost that needs to be charged to the IHS program of $5,069. And so in the IHS fund, the journal entry will be indirect cost expense, debiting that by $5,069, and then crediting your due to indirect cost fund. Because the indirect cost fund is where you're actually incurring those expenses, like I showed you on the previous slide. And then on the indirect cost fund side, you would debit your due from your IHS fund of $5,000 and then credit your indirect cost revenue. I know some tribal governments choose not to do the due from entry in this case, and they true it up at the end of the year, but this is what the ideal journal entry would look like for charging your indirect cost to the program. So this is during the year. And then after the year is over, If you're using a fixed carry-forward rate, which is the rate that's typically used by tribal governments, you would true up your budgeted cost to actual cost during your indirect cost proposal process. Now, there are three different types of rates. There's a provisional final rate. That is, basically the provisional rate is a temporary rate that you use for the year, and then you true it up based on actual cost to get your final rate. There's a predetermined rate that's basically a permanent rate that you would use, and the assumption is that that rate approximates your actual rate for the year. And the fixed carry forward rate is based on estimated costs, typically the tribal government's budgeted costs, and those costs are then trued up based on actual costs, and there's an adjustment between the estimated and actual cost. That adjustment is carried forward to the calculation that you do for the next indirect cost proposal in the subsequent year. So I've put the 2 or 3 years in red font. For many, many years, Interior Business Center always gave me an example of you can use a carry forward of 2 years. So you can look back 2 years to calculate your future indirect cost rate. But Interior Business Center also allows you to use a 3-year period. And the reason that 3-year period might be more beneficial to you is that, for example, say you're closing your 2020 books, you've completed the audit for 2020. Now you're putting together your indirect cost rate, your proposal in 2021. With that, there's also typically it takes about 9 months, or you have 9 months to complete your audit. And then the Interior Business Center itself usually has a backlog in reviewing the indirect cost proposals. The most recent backlog timeline that I saw was 12 to 15 weeks. That was end of December when I saw that. So by the time you actually get your rate, your following year has already started if you were going to use a 2-year rate. But say you're closing your 2020 year and you're applying for a rate for 2023, that means before your 2023 year starts, you already would have had your negotiated rate in your hand. So you can start out your 2023 year with your negotiated rate. And it looks like we have another polling question, Amy.
All right, thank you. The third polling question, which of the following are examples of rate types? Provisional, predetermined, fixed carry forward, or G, all of the above? And while you're answering, for those that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts, and we're also sending them via email tomorrow along with a recording of the webcast.
Looks like most people are getting the answer right. It means you've been paying attention. I appreciate that.
All right, here are the results.
Great. Yep, you can use all of the above. Most typically used is a fixed carry forward rate. So an example of a fixed carry forward rate. Let's say for 2020, your negotiated rate was 40%, and your direct cost base for 2020 was $10 million. However, your actual indirect cost for 2020 was $4.2 million. But based on that calculation I showed you of what your maximum indirect cost recovery can be, you got to multiply your fixed rate by the direct cost base. So your actual recovery for 2020 can only be $4 million, which means that you have an under recovery of $200,000 because your actual indirect costs were $4.2 million, but you only got $4 million. So your actual rate for 2020 was actually 42%, but we didn't know that because we use estimated costs to determine that negotiated rate for 2020. So in this example, I'm using a carry forward for 3 years. So I have an end of recovery in 2020 for $200,000. What this means is when we're preparing the proposal for 2023, let's say you have actual indirect cost of $4.5 million, and by actual, that should have been budgeted. So budgeted for 2023 is $4.5 million. And then carry forward from 2020, because you had an under recovery of $200,000, you add that on to get total indirect cost of $4.7 million. And your direct cost base for 2023, let's say that's also $10 million. So with your fixed carry forward rate, your rate for 2023 will be 47%. If you hadn't used your fixed carry forward rate, if you had a predetermined rate, it would have been 45%. So that's how that carry forward adjustment works. You just apply that adjustment based on your actual cost to the following to the following proposal that you're applying the rate for. All right, now we get to the fun part of strategies of indirect costs. And this is fun because I'm a nerd. All right, so ISDA, for those of you that don't know, it's the Indian Self-Determination Education Assistance Act that was passed under Public Law 93-638. I use these terms interchangeably, ISDA 93-638 or 638. It all means the same thing. So as a tribal government, you receive ISDA funding, and you get 638 funding and non-638 funding. Now, some federal agencies won't allow you to charge your negotiated indirect cost rate to the program. It might be lower than what's allowed, and you can't charge higher than what your negotiated rate is, but some agencies will let you only charge an X amount of percentage. So for example, Head Start, I believe, caps your admin cost at 15%. So you can't charge more than 15% to the Head Start program. However, 638 contracts and compacts are fully funded, and they will follow the negotiated rate of the tribal government. So for non-638 funding, say your tribe's indirect cost rate is 33%, and it's a non-638 contract that only pays 20%. So where does that money come from to pay for that indirect cost pool, for that difference? That comes from the general fund. The tribe's general fund has to bear those expenses because not all grants are paying their fair share of their indirect cost rate based on your actual pool cost. So the benefit of indirect for 638 funding is here in this example that I'll show you. So, for example, your tribe receives a grant contract of $600,000, and your indirect cost rate is 30%. Let's say it was a 638 contract, which means you receive $600,000, but under 638, you get indirect cost as an add-on funding, which means you get your indirect cost that you receive above the $600,000 will be 30% of it, which is $180,000. So the total funding available for the program is $780,000. But if it was a non-638 grant or contract, of the funding that you received of $600,000, indirect cost comes out of that $600,000. So you still have $180,000 to use for indirect cost. However, now you only have $420,000 to be spent on direct program costs. Now, this is a concern for many program directors that are not operating 638 contracts. So the question is a high rate bad? And program directors, non-638 program directors, will typically say yes. Indirect cost is just a tax that the tribe takes. The higher the rate they have, the less I get to spend on my direct program services. Like I showed you on the previous slide, that non-638 program only had $420,000 to spend on their program when they were probably really happy when they saw a grant of $600,000 coming in, but they actually only got $420 because $180 went to indirect costs. However, a CFO or finance folks will typically say, no, a high rate is not necessarily a bad thing. If most of your grant funding, or a large chunk of your grant funding, is coming from BIA IHS funding, which fall under your 638 grants and contracts, because that indirect cost funding is that add-on funding. You get more funding from IHS and BIA if you have a higher rate, unlike for your HUD, EPA, USDA, other programs. That doesn't allow you to charge indirect on top of the normal grant amount. And this only works if you have some general fund money that you have available to subsidize the programs that can't pay those higher rates. So I'm going to go through a few high rate scenarios to show you what strategies can be evaluated. So in this example, in scenario A, it's just a base example of we have an indirect cost pool of $1 million, a direct cost base of $2.65 million. That's the numerator, that's the denominator. When I divide that up, I get an indirect cost rate of 37.7%. And then here are my programs: IHS, BIA, EPA, TANF, Head Start. I say Head Start, parentheses, IDC is capped, the indirect cost is capped at $25,000. That's just in my example here. And then we have an indirect cost pool of $1 million to get a total budget of $4.6 million. So in the second column, it shows the exclusions. This is assuming you have a direct cost minus exclusions direct cost base. Your direct base is that third column. And then that indirect cost collected, that's your indirect cost recovery. And based on that formula I showed you earlier, if you multiply that $400,000 of IHS by 37.7%, you get the $150,943. However, if you look at the first column of total cost for IHS and BIA, the total remaining that you can still use for the program is still $1 million each, because remember, IDC is an add-on funding for these programs. But if we go down to EPA and TANF, now suddenly your remaining for the program column, the last column, compared to the first column for EPA and TANF, it's lower because now you're taking away funding out of the total cost for the EPA and TANF program. So you only have $330,000 available for EPA and $511,000 available for TANF, because the rest is going to the indirect cost calculated. And Head Start, we're saying they're capping it at $25,000, so that's why that's there. It's not based on the indirect cost rate. So this is the base example. Now, if I go to my scenario B, let's say I find out of the BIA program there are about $100,000 of costs that can actually be charged to the indirect cost pool. They should be charged to the indirect cost pool. So I'm moving out of the BIA of $1 million, I'm moving $100,000 to the indirect cost pool. What does this do to the equation up here? My indirect cost pool goes from $1 million to $1.1 million, and my direct cost base decreases by $100,000 from 2.65 to 2.55. So my numerator increased, my denominator decreased. That means my indirect cost rate now went from 37.7% on the previous slide to 43.1%. And I'm sure this was already communicated to you, but you all have these slides, so you can go back and forth to on your own as well. So now the rate is 43.1%, which means for BIA and IHS, the indirect cost that's collected is at a higher rate. You get that add-on funding. However, that also means your EPA and TANF programs now you're charging a higher rate to them. That means you have less money available to your programs. In this example, we're not subsidizing the programs with tribal general fund money. So there's basically less money available for the EPA and TANF programs. And just a note, I realized only yesterday when I was going through the presentation that I used red fonts in my examples for things I wanted to highlight, but the red font does not mean they're in the red. It's not a negative, it's still a positive. Any negatives are shown in parentheses. All right, so if I go down to the benefit to tribe on the bottom, here's what this did in this scenario when I moved $100,000 from BIA to the indirect cost pool. I have an additional BIA carryover of $100,000. But I also have a decreased indirect program cost, $100,000 that wasn't used for BIA, and then that $51,313, that is the increase in indirect cost collection for the EPA and TANF program because of the increased rate. So there's less money available for the EPA and TANF of $51,000. But because I increased that rate, my increase in indirect cost collections were $81,095. So my net benefit to the tribe in doing this was $29,782. All right, so now if we go to scenario C, let's say we're doing the same thing as scenario B, where we're moving the 100,000 from BIA to the indirect cost pool, but now we're subsidizing the non-638 programs. When I say subsidizing the non-638 programs, I'm saying that the EPA and TANF programs now are still being charged at that initial rate of 37.7%. However, the reason they can do that is because the general fund is covering the difference between what would have been charged if they had used the 43.1% rate. The general fund is covering that amount. So EPA and TANF still have enough funding as they had planned for initially of the 330 and the 511 for EPA and TANF. So in this calculation, the benefit to the tribe is on the bottom, again, an additional BIA carryover of the 100,000, decrease in direct program cost of the BIA, right? That's no longer $1 million, it's still the 100,000, or still 900,000. So decrease in direct program cost of BIA. That increase in indirect cost collected is now 29,000 because it increased for BIA and IHS, but we did not increase the indirect cost collections on EPA or TANF. So the net benefit to the tribe in this scenario is 29,782. Now, if I go to the next scenario, similar to C, however, now I'm increasing the BIA spending by another 100,000. So I'm back to having $1 million for BIA total cost instead of the 900,000, and we're still subsidizing the EPA and TANF program. This increases my indirect cost pool by my indirect cost pool is still 1.1 million like it was in scenarios B and C, but this increases my direct cost base by 100,000 because now I'm using BIA, I'm spending another 100,000 on BIA. So that decreases that indirect cost rate because the denominator increased. So it went from 43.1% to 41.5%. However, because we increased spending on BIA, that means the indirect cost collected on BIA is also higher because that's an add-on funding. So in that calculation, there's no longer an additional carryover of BIA because we used that 100,000. There's no decrease in program cost because, again, we used that 100,000. Then we get to that increase in indirect cost collected because of the additional BIA spending. So the net benefit to the tribe in this scenario is 50,943. So these were some scenarios of a high rate example. So you evaluate the strategies on where making sure that the indirect cost pool has the proper cost, BIA, the 638 funding has proper cost within each of those bases. And if they need to be adjusted, or if they can be adjusted, if they're allowed to be adjusted, then they should be if it benefits the tribe. So like Tasha mentioned, there are different direct cost bases that you can use. There's the total direct cost, excluding expenditures, pass-through, subcontracts, participant costs. Regarding subcontracts in excess of 25,000, just one note, this specifically talks about you can leave 25,000 in the base of the first 25,000 of each contract. So if you have a contract that that's a multi-year contract, it kind of gets complicated to track that which year you included the 25,000 in the base for, and then which years you're excluding it. So something to keep in mind, but that tracking can get a bit complicated. Or you can use direct salary and wages or direct salary and wages and fringe. I think Tasha also touched on this. Sometimes using that salary and fringe as a base can be a benefit to the tribe. Here's why. Typically, salaries and fringe are more of a consistent expense, not counting the pandemic and the Great Resignation and Great Reshuffle and vaccine mandates that has affected a few tribes. But, not counting the pandemic, typically salary and fringe are a consistent cost. So we don't normally see as many fluctuations if you're using a salary and fringe base. And you can also get a benefit from using salary and fringe depending on what type of funding you have. So let's go through that scenario. let's say in this example, the indirect cost rate is 25%. We have a column for IHS, a column for BIA, and then a column for all non-638 funding. And at the top, we show the grant revenues, indirect cost add-on, any tribal subsidy, that's funding from the tribe's general fund. And then we calculate the direct cost. In this example, this is a salary and fringe example. So the direct costs are your total salary and fringes for each program. For the IHS program, the subtotal of direct cost is $6 million. Multiply that by 25%, you get to your indirect cost of $1.5 million, which is the second to last line item on this table. For BIA, it's $1 million because their direct cost base was $4 million. Multiply that by 25%, you get to the $1 million. For the non-638 funding, it's $2.6 million. The indirect cost is $665,000. Now, the tribal subsidy, the reason the tribal subsidy in the non-638 funding is so high is basically this is telling you as management, as council, that these programs are not paying their fair share of, or not taking the burden of their fair share of the burden of the indirect cost pool expenses. So that's why the general fund is having to pay for them. So let's say we are able to shift some salaries from non-638 programs to BIA programs. So in this example, I have found $1,460,000 worth of salary and fringe that I can move out of the non-638 funding and into the BIA program. And this is not, we still need to make sure your salary and fringe are allowable under the BIA program. So it's a matter of really going through the salaries, the employees, and job descriptions paid under non-638 funding to evaluate if any of them can be charged under IHS or BIA. So let's say, we're able to find $1.46 million. So we shift those salaries out of the non-638 funding and into the BIA program. Using that indirect cost rate of 25%, now I have, I've increased my direct cost base for BIA from $4 million to $5,460,000. Multiplying that by 25%, now I have indirect cost of $1,365,000. So I just increased that BIA add-on funding, the indirect cost add-on funding for BIA by $365,000. And what this also did is because this decreased the cost in the non-638 funding, now my tribal subsidy, I don't have to use general fund to subsidize the 638 programs as much. So it went from, I don't remember what the dollar amount was. It went from $925 to $560, this tribal subsidy. So on the right here, I get to that net benefit scenario of, in this scenario, I have increased add-on funding from BIA because I increased the direct cost base for BIA, and I decreased tribal subsidies. So the net benefit to the tribe is $730,000. So I highly recommend tribal governments evaluate their indirect cost pool, evaluate not just the direct cost basis, but also evaluate costs that are being charged, salaries that are being charged, depending on which direct cost base you use, costs that are being charged with the pool and your direct cost base, to play around with different scenarios, with different strategies, to see how you can maximize benefit to the tribe. The goal would obviously be to reduce your general fund spending and maximize the federal funding that you're receiving. All right, it looks like we have another polling question.
All right, so our last polling question is true or false, having a high indirect cost rate results in less direct funding available for programs? A, true, B, false, or C, it depends on the program. And once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. All right, it looks like most people have responded. So here are the results.
All right. You all were paying attention. Yep, it does depend on the program. All right. So a reminder on CARES Act. So guidance came out from Treasury and from the Interior Business Center in November of 2021 that you can exclude any CARES Act funding that did not allow you to charge indirect cost or limited indirect costs from your indirect cost calculation, from your indirect cost proposal. This was a question that we received a lot in 2020, and we didn't have an answer. We didn't know that this is something the Interior Business Center or Treasury would allow, but they are allowing this. So, but if you already have finalized your 2020 or 2021 indirect cost rate where you included CARES Act, please do reach out to lead negotiator. They will work with you to correct that. Also, while I'm talking about CARES, also want to make a reminder for ARPA fiscal recovery funds, you are allowed to charge indirect costs to the ARPA fiscal recovery fund. So that is definitely allowable. All right. So now we'll go to some Q&As. Yeah.
Thanks,
So
Anita.
Tasha, did you want to start out? Yeah.
Yeah. So one question here is if you used a PPP loan or CRF funding to cover payroll expenses for positions that are typically included in the indirect cost pool, how does this impact the indirect cost rate? So really getting at that last slide you just talked about.
Oh, I'm sorry.
Do you need me to repeat the question?
Yes, please. I'm so sorry.
That's okay. It was what happens if you used a PPP loan or CARES Act CRF funding to cover payroll expenses for positions that are typically included in the indirect cost pool. How would this impact the indirect cost rate?
Yeah, good question. That's definitely that some tribes use that to cover costs that were previously in the indirect cost pool. Unfortunately, what that does is that decreases your indirect cost pool, so it decreases the denominator, so that could decrease your indirect cost rate. I don't know what your base looks like, but decreasing your pool definitely would decrease your cost rate.
Absolutely. And then another question here related to office kind of rental costs. So it says, what happens if you charge office rental costs as an indirect cost 1 year, but you kind of reevaluate and decide to charge it directly to programs in the following year? How does this impact the indirect cost rate?
Two things on this. If you're moving that rental cost from the indirect cost pool 1 year and moving it to a direct program cost, that's decreasing your pool and you're increasing your direct cost base. So that will most likely decrease your rate. The bigger issue, that in addition to that issue, is that based on my negotiations with the Interior Business Center, if it's not already included in the pool in the previous year, they will question, they'll look at it with more scrutiny if it's then added back to the pool in the following year. So keeping that in mind is important as well.
Great. And then we got a couple of questions in here that are just along the lines of, what's the average IDC rate we see in Indian country, or what is the range of indirect cost rates that we see for our clients? So I'll let you weigh in, and then I'll add my 2 cents on that one too.
Yeah, we see rates that can be, maybe very, very lean accounting departments or, admin departments. They can be as low as 19%. I would say the more average rate that we see is It's in the 30s, about a 1/3 cost, and usually in the 30s. But then there are tribes that do multiple rate structures where for their 638 funding they may have a much higher rate, and then for their non-638 funding they have a lower rate. So I'm seeing rates that go up to 80%, 90% for some 638 funding. So it very much depends on the tribal government structure.
And it very much depends on your direct cost base, right? So I think what you're referring to is probably a tribe that uses total direct costs less exclusions to get at that 30-ish rate, which I would agree is probably about the average. But if you're using salaries and fringe, again, you're shrinking the denominator, and so that increases the rate. It doesn't increase how many overall costs are getting allocated, as Anita went through. And so on a salaries and fringe, it can be 60. I've got some that are over 100% when they use salaries and fringe as their base. So unfortunately, the answer is probably, as Anita kind of indicated, it depends. There's a lot of facts and circumstances that go into that. Let's see. Oh, here's a good one. Can you only charge federal-funded programs for indirect, but not general fund programs indirect? So how does the indirect apply to the non-grant portion? All of your examples were talking about, kind of the federal share. What about the rest of it?
Mm-hmm. Yeah, so you're supposed to charge indirect to all of your programs equally. Even if you don't end up charging your general fund, the indirect cost pool, your general fund will take the hit for the costs that you're not recovering from your federal programs. But Interior Business Center would definitely question you if you're not charging your indirect costs to all programs equally.
Yeah, so to say that a different way, some tribes actually record journal entries to allocate or charge indirect to their general fund programs to kind of track that. Regardless of whether you elect to do the journal entry, which isn't necessarily required, it might be a good management tool, best practice. The calculation presumes that you're charging that rate. So, and again, if you think about some of those examples that Anita shared of what happens when a federal grant doesn't pay in, ultimately the general fund is paying for it, right? Because you're incurring expenses, but there's no revenue coming in, getting allocated to other programs. So either way, at the end of the day, the general fund is paying for any of that unfunded indirect. So I think that's probably all the time we have for Q&A. Anita, do you want to wrap up the remaining, or maybe it's Amy wrapping up the remaining couple slides?
Yeah, and if we didn't get to any of your questions, we'll definitely respond back by email. Just to give you a heads up, we will be going over, you all probably know ARPA released their final rule in January, so we'll be talking about how that impacts tribal governments. Tasha and I and our colleague Ryan Lukemeyer will be on that session on February 23rd. And then Amy, back to you.
All right, thank you. Before we close, I do want to remind the attendees that we have a lot of resources available on our website, and we have linked a few of those directly for you in your console, so definitely check those out. And thank you, Anita and Tasha, for a great presentation today. And thank you to our audience for submitting your questions to help guide the conversation. As Anita mentioned, we will do our best to follow up with you after the webcast if we didn't get to your question. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 3 weeks should you have difficulty downloading it now. And finally, here is a link to an online survey for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. And thank you for joining our webcast. Take care, everyone.